Okay, good afternoon to all of you who are connected. We will be waiting for a few minutes so that we can start in, I would say, probably around 2:37, 2:30, 2:40. Um, whilst we will have a larger community, and I will start to introduce myself and tell you more about how this first live session will be basically will evolve. So if you don't mind, we wait for a few minutes so that we have a larger community because it's the first one and everybody has to connect itself and probably some have problems to connect and we want to wait for those persons who wants to join but may have some issue to join us. Thanks for your understanding. Okay, let's get started. I think this is the first kickoff session, live session of this sponsors MOOC on infrastructure finance. Very few infrastructure finance MOOC have been created so far, and we are particularly proud of launching this MOOC in a very fruitful collaboration with UNO. And what I will propose you as a menu for today is, first of all, to introduce myself to you and to have a few minutes to tell you more about me. And then and I would encourage you to start right away to think about your questions. So already think about questions you may have raised in the past, or even if you have not raised those questions, maybe you could have some questions left pending, and you would like these questions to be addressed during this MOOC live session. So don't be shy. Write those questions down and send it to me. They will be treated during this live session for sure. And even if I don't have the time to treat all the questions, which obviously may happen because we have only an hour, we will be taking steps after the MOOC session to address those questions and handle those questions. And we will post the answers on the forum so that everybody participating to the MOOC benefits from these questions and also the answers attached to it. So again, short presentation, questions, and every live session would have a theme, short and concise theme I would address. And this theme today, as it is an introductory session on infrastructure finance, will mainly deal about the topic of what is infrastructure finance, why infrastructure finance has become so sought after by the investors, and what are the opportunities offered by the infrastructure finance sector. So let's start with a few words on me. My name is Patrick Daguet. I am the expert for this MOOC on infrastructure finance. I have 35 plus years of experience in banking and finance, having dealt with several positions during these 35 years, starting with typical corporate finance and corporate banking, then switching to retail investors. And again, after I've worked in various positions in banks, in fixed income, also in equity and quasi-equity, and ultimately I spent the last 15 to 17 years in institutions like private equity funds and infrastructure funds, where my primary role was to help my investors to invest into projects, infrastructure projects in the transport sector, mainly in the transport sector in OECD countries. I've done that for more than 15 years. And I've seen many configurations, those involving, I would say, plain vanilla finance structure, and also other structure which are more complex. Obviously, this led me to, when I started to think about how can we help participants to know better what infrastructure finance is, this actually brought to my mind the idea of building something through a MOOC. And that's how this idea of a MOOC was ultimately born. So that's precisely my resume in a few words. So if you have already questions, don't hesitate to pose those questions. And absent any particular questions so far I can address, I would switch to the theme I want to address today, which is an introductory theme for infrastructure finance, mainly centered around what is infrastructure finance and why investors so much are increasingly looking at increasing the size of their assets invested into infrastructure. So for that, I will happily share with you a presentation which whose the paternity is from Natixis. So I don't want to hide anything, and I would give to Caesars what is to Caesars. So it's an interesting presentation which was done a couple of weeks ago by one of the main representative of Natixis, and whom I invited here in Paris to make a conference. And this person, which is who is the head of the fund of infrastructure finance in Natixis, brought us some interesting perspective and information on infrastructure finance. And let me share that with you right now. Okay, hopefully you can have a view of on what I want to share with you, and what I would like to address as a first point is what is the investors' sentiment and, about infrastructure finance. And this sentiment is investors are increasingly interested in increasing their allocation to infrastructure finance. And if you look at this graph on the left-hand side of the screen here, this graph shows the intentions of investors for their infrastructure allocation over the long term. So in other words, these numbers came from a survey which was conducted to investors, asking them, would you like to increase, decrease, or maintain your allocation on infrastructure finance going forward? And as you can see, massively these investors decided to increase. 46% declared that they were willing to increase the allocation they were so far dedicating to infrastructure finance. And this is an interesting number, obviously, bringing some insight on infrastructure investors' intention. And if you look a little bit closer, on the right-hand side of the screen here, you have the number of infrastructure investment active institutional investors plan to make over the next 12 months. So, in other words, how many infrastructure investment active investors want to do, what is their intention over the next 12 months. And here again, what we can see is that they want to increase largely in terms of number, 44% want to increase their investment in the next 12 months, and definitely that confirms what I was telling you just a few minutes ago. And when it comes to money, you look at this as an intention of investing in infrastructure, and what is the ticket investors would like to commit on infrastructure finance over the next 12 months. Well, you can see that they would be willing to commit, at least if you look at the large percentages, you see that between $100 and $349 million, 28% would be prepared to put this type of tickets on an infrastructure investment. And if you add to that, you have also 50 to 99 million, 30% would be willing to commit at least these amounts on infrastructure finance. So that's quite interesting as a survey, and this survey was done by Prequin in 2014, so it dates back basically a year and a half ago. But still, these results are still valid. But these results are valid, and you have also the another way we can look at that is obviously the needs. What are the needs, and are the needs sufficiently important to foster a pipeline? Because whenever you want to create a fund, an infrastructure fund, or whenever you want to commit yourself in this sector, you would ask a simple question: are there sufficient needs that would ensure my pipeline of deals and flow to be filled? And here what's for sure is that the needs are extremely important. Look at continental Europe. I'm not talking about the rest of the world, but only sticking to continental Europe. You have this so-called Europe 2020 strategy, which was launched by the European Commission back a year ago. And this initiative assessed the needs of investment in infrastructure being comprised between 1.5 and 2 trillion dollar or trillion euros, sorry, of investment before 2020, which means it's the day after tomorrow. Typically, it's not a year in a year's time; it's the day after tomorrow, and this would be spread between three sectors: transport, energy, and communication. So, and you have the split here. A large part would basically deal with the transport. Nearly, I would say, close to 2/3 of it, and a big chunk would be energy and information and communication networks, the 3Gs and 4Gs and the fiber is going to be representing probably 15%. So it's quite interesting to see that just in Europe, again, we are talking about this type of investment figure, which demonstrates even more the importance of the needs that need to be covered. So if ever you had some doubts, if ever you felt that the infrastructure finance area was, we were making a big fuss about it, but there was not that much needs, I'm sure you will be convinced, at least for Europe. But if I increase my scope and talk about the world, obviously it's even more, it's much more, because developing countries have huge needs of infrastructure, specifically, not that much in information communication, but needs in energy, needs in sewage and water systems, needs in solid waste treatment plants. These, added to these ones, bring us to double-digit trillion numbers in terms of global infrastructure needs for the world. So yes, there is huge needs, and let's face it, for the time being, the supply and demand. So you have clearly a demand of infrastructure. Regarding the supply, in other words, the cash to be invested in it, there is still a substantial shortage that will need to be addressed in a way or another. And that's an interesting fact and interesting topic. Let me switch to the question, see if there is any question I can address at the time. Okay, so I move on. I move on my theme here. So we have this continental Europe, European 2020 strategy, and interestingly enough, when we look at this graph, which shows the on the x-axis the degree of maturity of the country compared to its ranking in terms of separating three different categories. One is emerging. In other words, what are the countries where there is a minimal infrastructure, privatization, and small number of deals? Then you have the maturing countries where you have obviously a large part of the deal flow ensured by regulatory changes and privatization schemes. And the third, which is the mature market, which is mainly dealing with countries where you have an established regime for infrastructure privatization and a large number of deals. So when you look at this, graph, several interesting features could be addressed. Let me address a couple of those. The first is, you can see the mature country are mainly countries of the Commonwealth, Mainly, you have Australia. You could have also put some other like New Zealand. You have obviously the UK. You have the Canadian. Canada is it's no surprise if we see those countries ranked as mature in terms of infrastructure because they have embraced the infrastructure finance for many decades already. It's not betraying the reality to say that Australia, Canada took the public-private partnership schemes as one of their primary model. They developed a program for schools, program for universities, program for hospitals, to name a few, where they developed the public-private partnership scheme, principally because they had a huge shortage of money on these sectors, and they had also huge needs to fulfill an ambitious program. Not to speak about the UK. UK was, as you probably know, was the first promoter in Europe of public-private partnership scheme through the PFI model and Project Finance Initiative. Project Finance Initiative, which helped reconcile the public body interest with the private body interest, trying to make public and private sectors work together for developing school scheme, for developing transport scheme, for developing prison scheme, hospitals. They also renovated and rebuilt the MI5 through the PFI model. So you can look at many sectors in the UK which ultimately benefited from the application of the PFI model, which then was exported abroad, principally embraced by Commonwealth countries, as I said, and also you had Canada, which prevailed in northern America, American continent. Canada prevailed as the promoter of a public-private partnership on this continent. This is the first block of countries. In this block, you have also the Nordic countries, specifically the Scandinavian countries. I'm thinking of principally Sweden and the Danish country, which also embraced public-private partnership schemes. The second category of countries I would like to put a light on are actually countries which have put regulatory changes in place, trying to boost infrastructure privatization, and where you have still a moderate number of deals going on. On this particular group of countries, you find countries as diverse as obviously France, Benelux countries, Germany, Southern Europe, Spain, mainly Spain and Portugal. US is part of it as well, and some Central European countries which join the pack. So in this particular group, you have reforms which were put in place 10-15 years ago to promote public-private partnership schemes, to help promote project financing for all the sectors, including sectors of the economic infrastructure. So economic infrastructure, in my view, are sectors whose payer are the users. So transport is a good example, but also in social infrastructure, whose payers are not the users, but payers are the taxpayers. In other words, anyone in the country who contributes to the financing of a public service. So be it on the social or economic sectors, these two sectors benefit from public-private partnership scheme in these countries. But the difference between these countries and the first group I mentioned, which are mature countries, is that it took place, these reforms were only put in place recently, and we don't have, in these countries, we don't have sufficient leeway or experience to judge whether it was a real benefit for the country as a whole, whether it was a real benefit for socially and economically. So it would take more time for us to judge that. But it is clear that these countries, they have started to switch to PPP project finance modes, but still more recently than the mature country. So they are in the process of maturing, but they still have some time to go. And the final group is the emerging country. The final group is the emerging countries where you don't have a culture of public-private partnership. You don't have a culture of infrastructure privatization. A large part of the infrastructure of the country is either in the hands of the government or still to be built. And neither the project finance nor the PPP have been ever considered so far. So I would take example of obviously India, China. In these countries, we know project finance the old way. I would say we know project finance the old way. When I say the old way, let's clarify my words. When I say that, I mean in this country you can build a bridge, you can build a dam, you can build a motorway, but largely the way it will be built and financed is traditionally from the government's money. And when they involve the private sectors, it involves local private players whose link to government is relatively strong and close. Therefore, it's not a true public-private partnership. It's in reality, it's a public-to-public, I would say, project financing. And even if the party involved is legally private, their links to the government are so close that you could disguise it the way you want, but it's ultimately traditional public finance. And you have some exception though, like some Southeast Asian countries like Malaysia or South Korea. They are on the verge of taking the train, embarking into the train of maturing countries, and trying to start some experiment in the PPP. And obviously, one of the candidates here is Latin America, particularly Chile. Chile was an early adopter, one of the early adopters of project finance because they have a specific system in Chile, which is quite unique in Latin America. They very early developed pension schemes, and they have large pension funds. And as such, these pension funds, whose role is to manage retirement benefits for elderly, these pension funds have a lot of liabilities, which are long to very long-term liabilities, and they are in search of long to very long-term assets matching those liabilities. And precisely what they will be looking for is stable, relatively stable and predictable cash flow stream to match those liabilities, which are also relatively stable and predictable. Therefore, the infrastructure assets are close candidates or preferred candidates for these type of funds. That's why in Latin America, in Chile, transport projects like motorways and urban motorways and airports were financed through Chilean pension schemes, pension funds, without necessarily having the need to involve foreign funders or involving even the World Bank. So these infrastructure were mainly financed domestically, which is quite an unusual feature for a Latin American country. So, this is an example, Latin America and Chile, this is a very good example of a country that ultimately succeeded in bringing to the forefront a form of project financing, domestically funded, which is relatively unique in this part of the world. So drives me to one of the key message I was willing to address today. One of the key message I was willing to address today is what is infrastructure and what are the key characteristics of infrastructure, and also what are the key benefits for the investors. But before jumping into this, I will see if we have questions so that I can address those questions to you live. So I'm looking at the questions here. Okay, I have a question. I would like to ask you, what is earmarking of revenues? This is an interesting question because earmarking of revenues is often referred in project finance, because project finance, and that's part of the topic I was willing to dig into in a few minutes, but you give me the opportunity to dig into in advance. Project finance is about financing a single asset, through a specific special purpose vehicle whose sole purpose and sole goal is to fund the infrastructure with the money of the users. So if I decide to fund the infrastructure, now through debt and equity, it's simply in anticipation of future flows, which will help me to repay my debt and give a decent return on equity, thanks to the users, which will pay the infrastructure for their use. So if I build a motorway, for example, 120 kilometers motorway, as a user, I will pay to the toll booth my toll, and this toll will be earmarked and specifically isolated for the sole purpose of paying my expenses, my operating expenses, then paying my interest and principal on the debt, finally paying a decent return to the investors who decided to join me in financing and building and designing, building, financing and operating this road. Because these lenders, these shareholders, they expect obviously that all the revenues coming from the toll booth will be fully and exclusively earmarked to the payment of operating expenses of the toll motorway, then interest and principal on the debt, finally having a decent return on equity. So earmarking is simply the process of allocating exclusively a revenue to the repayment of several expenses. So avoiding these revenue to be scattered around several other projects. Only a single project will benefit from the earmarking of revenue. And this is exactly the sense of earmarking. Hope it addressed your point, but that was a question that was raised by one of the participants, and I think it was useful for the whole community to get an answer on this. Another question I have here. Okay, well, if Indonesian rupiah, well, okay, um, the question is not about Indonesian rupiah. It's about how do you deal with the inflation issue when well, the inflation and the effects actually. So that's a very interesting question because you have a lot of ramification linked to this question. I will try to address this question from several angles, if you don't mind. When, for example, we were involved in Chile building this urban motorway, we were involved with European partners. All of them were more or less euro-denominated currency. They were reporting their reporting currency were almost all of them, if not all, were at that time it was euro, and they decided to build a venture and to build a special purpose vehicle, to build a company whose purpose would be to design, to build, to finance, to operate, and ultimately transfer to the Chilean government a urban motorway, and this obviously in a currency which will be different from the currency in which they report. So can you imagine that? You create a startup because it's a startup company. You fill the startup with staff. You fill the startup with money. And this money is when the shareholders invest, they will have to, because they don't have Chilean, they don't have the Chilean currency, so they will have to acquire this currency and to invest, to put an equity stake in this currency, in the startup, and then you go. In other words, you go for not for 2 years, you don't go for 5 years, you go there for 25, 30 years, even more, sometimes 35 years. And we all know that when you build a financial model, and we always build a financial model in these instances, when you build a financial model with your revenues, your expenses, you don't do that for a couple of years, you do that for 30 years. And you would be foolish, for sure, if you don't integrate into your financial modeling inflation impact. So what we do, and this is one angle of your question, what we do is whatever revenue line we fill, whatever expense line we fill, we put as an intake the inflation rate, which is an anticipated inflation rate. Obviously, we can't anticipate what will be the inflation rate this year and maybe next year. What about what will be the inflation rate in 2 years' time, 3 years' time, even more? So 20 years' time is nearly impossible. We don't have a crystal ball. And here we have to take some assumptions. Obviously, we have to take a trendy assumptions. Even if we look at OECD countries' forecast or forecast of the global economist, it's an indication, but it's not a commitment. So we have to be extremely cautious. So one way to address your point, we put inflation on the model items, revenue and expenses. And second of all, we also put into the model sensitivity analysis and scenario-based analysis where we sensitize the inflation rate on the country, because we know that if in Europe, for example, inflation rate is more or less 1.5–2% a year, well, in Chile, it could be 4% a year, and then the year after it could be 6%, and we could have double-digit inflation going forward. And as you know, inflation can hurt you in many, many ways. It can hurt you in all aspects of your financing. It can help you. It can also help you in a way, but ultimately it may hurt you if you don't put these inflation and you don't take into account this inflation in your numbers in the financial model. Then Um, Another problem with this is the currency. And why did I talk about inflation? Because I want to make the link with the currency. There is a strong link between the domestic inflation compared to the foreign inflation. When I say foreign inflation, I mean the inflation of the countries where the investors are. So if you build a consortium of European investors, mainly the investors would have euro as a basis, and they have a euro where inflation in the eurozone will be, 1.52% a year. So this is their benchmark. This is their basis. On the other hand, we will have euro with its inflation, and we will have the Chilean currency with its own inflation. Everything will be converted into Chilean currency, and the challenge here is to be able to finance Chilean denominated assets with Chilean denominated liabilities. In other words, if I bring my equity on the table, assume the equity represents 10-50% of the total financing need. You need to find the 85%. Where do you find the 85%? Through the debt market. Who would lend you? Well, foreign lenders and domestic lenders. If you have a domestic financial markets, like it's the case in Chile, you would tap the domestic market. You would try to avoid as much as you can. You would try to avoid to have a currency denominated of your debt denominated in a currency which is not the currency in which you receive your revenue. If I have invested into Malaysian in Kuala Lumpur, for example, to build a toll road in Kuala Lumpur, I will receive my revenue in Kuala Lumpur ringgits or Malaysian ringgits. And these Malaysian ringgits revenue will pay my expenses in ringgits. And when it comes to debt, interest and principal, if they are denominated in US dollar, I have a problem. And for sure, I want to avoid this. I want to have, why? Because debt service, interest and principal, represent a very large, by far the largest amount of expenses I have to face and I have to withstand. Therefore, it is clear that I would need to privilege and to give prevalence to domestic funding because it would reduce my exchange rate. The problem I have, if I don't find a domestic financing, like it could be the case in Indonesia or in Malaysia, I would have to tap the US dollar market, which for sure I will get some money. But then I will have to convert this dollar into Malaysian ringgit or Indonesian rupiah, and finding a swap for terms in excess of 5 years is so prohibitive that I will not be able to do that. I won't be able to do that. So the only way to circumvent this problem is to reduce the term of the financing. In other words, in countries where you can't tap long-term debt, you would tap short to mid-term debt like 5, 7, 8 years terms, and you will refinance every 7 years your funding. Why? Because you would have to find a hedge, a swap, a foreign exchange currency swap. And if you want to find a decent foreign exchange currency swap in the market, in other words, decent, I mean not so expensive, you will have to limit yourself in terms of maturity. And this maturity would be between 5 and 7 years. And obviously, this type of structure, which I just described to you as a series of 5 to 7 years funding, taking, you would have a first 5-7 years, then you would have a second 5-7 years, and you would have 5-7 years. You would strip the financing in several sub-financing is relatively risky. Why? Because you have to refinance every 7 years your project. And if your project fares well, okay, you will have no problem to find money. But if your project doesn't fare well, you will have problems finding money. So it exposes you to refinancing risk considerably, and that's a problem in countries where you can't find domestic funding. For Chile, we didn't have this problem. We were able to tap the long-term bond market for 30 years in Chilean currency, and we had no FX issue thanks to that. But it was a very interesting question. So let me switch to we have still 15 minutes to go, and I would like to switch to the presentation I was undertaking since the start of this book, to tell you a little bit more about the key characteristic of infrastructure. Infrastructure are considered capital-intensive assets, which are strategically important. And among those, you have public services, utilities like oil and gas, electricities, wastewater treatment plants, solid waste treatment plants, which fulfill major economic and social needs. And that's a very important point. When you have infrastructure, you have essentiality. If you don't find essentiality, you won't be able to finance it. That's a problem of financing the stadium. I have personally been involved in financing stadia, and I can tell you that stadiums are very difficult to finance because largely the finance community consider stadium as a non-essential infrastructure, which don't fall into the definitions that I just mentioned to you. Where is the essential need for the population? You know, the finance world will see essential solid waste treatment plant, wastewater and distribution of water system. They will find an electricity dam as a major essential infrastructure, but a stadium will not be seen as an essential infrastructure as such. Therefore, it's important to demonstrate for the bankability and for the capacity of raising interest to the finance community at large. It's extremely important to be able to demonstrate that the infrastructure you want to undertake has an essentiality. And usually the essentiality, let's face it, is demonstrated by the population need. It's also demonstrated by the public involvement in it. So if the government at the central or local level is deeply involved into it, it has one of the characteristics of essentiality. Otherwise, the government will not commit itself and its reputation if it was not an essential infrastructure. So this definition, which I mentioned to you a few minutes ago, is that infrastructure sector is mainly centered around public service essential to the population needs, and as such, it is characterized by a relatively inelastic demand for output of services. So, in other words, if the price of this service increased by twice its current level, it would not have a strong impact on the usage of the infrastructure by the population. People will continue to use the infrastructure, notwithstanding the fact that the infrastructure usage price has doubled. And that's characterized essential infrastructure. They have a relatively inelastic demand, and it's underpinned by obviously a quasi-monopolistic situation, which is ensured by the government. So if I am granted a license, or if I am granted the right to levy a tax or to levy a toll, on a toll motorway for 30 years, it means that I have no competitor. Whatever competition I can envisage, this will be stopped by the governments for the duration of my contract. At least I have a free lane or a free lunch, shall I say, for 30 years. But it's up to me to make sure I can do the best out of it, because after 30 years, I could lose my license, and this license could be attributed to someone else if I didn't do my job correctly, even before the end of the concession or the license. I could get kicked out by the government because I don't do my job correctly. So nothing is insured, nothing is secured. It's a fight of every day. It's an everyday fight. You need to be on top because you provide an essential services to the population. And if the population is not happy with the level of service you render, they will say it, they will tell it, and you will be warned once, you will be warned twice, and the third time you will be kicked out by the public sector, which will replace you by another private players. So it's extremely important that monopolistic situation has a price, and the price is it could be a formidable opportunity to make a decent return out of it if you operate it seriously and correctly, but you could also ruin your reputation if you don't do your job correctly. It's a double-edged sword. It's really a double-edged sword, and everyone involved in project finance know that. When they put their name on the forefront, they know they put more than their equity stake of $150 million, they put their whole reputation. When you have Eiffage, Bouygues, and the likes involved into projects, they put much more than their equity stake in the project. They put their whole reputation. And the last characteristic of infrastructure is its predictability on cash flow stream. So when you are given the license, you can operate your infrastructure for a very long term, and as such you can predict relatively stable revenue stream, and as such you would replicate bond type profile, where you will have invested at first, then you will have steady stream of cash flows, usually indexed with inflation, and an exit price at the end, like if you were buying a bond. Basically, it's like if you were buying a bond. So that's the main definition. And I think it's a very good definition, by the way. It's Moody's definition of infrastructure. And what are the key characteristics which we can attach to the infrastructure? Let me name a few to you. I would say that one of the key characteristics are you provide an essential services to the population. You create, and I refer to the Porter 5 forces analysis here, you create a significant barrier to entry, and you are generally in a dominant market position because you are the only one providing the infrastructure service. It's based and backed on long-term assets with a life which usually is in excess of 30 years. You have high upfront cost because it's very rare in infrastructure that you invest a few bucks. You invest, it's a capital intensive activity. You invest a lot at the start, but you get paid on the long term, relatively stable, but low ongoing operational cost, that's for sure. You have stable cash flow, we spoke about it, with low volatility. You don't have a high volatility around the cash flows. And these contracts you sign with the government have usually inflation protections through inflation link. This inflation link is ultimately coming from or stemming from the fact that your contract is, you have an indexation power of your services to the inflation. Therefore, you are protected, you have a natural edge against inflation. What are the benefits for investors? Because ultimately, if you want to invest, you are interested in knowing what are the invested. Well, I think one of those benefits is the fact that you have a risk-adjusted return, and definitely it complements a diversified portfolio. If I buy stocks, if I buy bonds, I would have an exposure on market risk. If I buy infrastructure assets, or if I buy infrastructure through debt or equity, I will get something which is completely decorrelated to the stock and bond market. Completely decorrelated. Things are, risk involved have nothing to do with this risk of bonds and stock. Hence, you achieve diversification by buying infrastructure assets. Some say it's close to real estate. It's partially true, but it's not real estate. It's fairly different from real estate at the end. But you have some characteristic of real estate attached to infrastructure assets. It's relatively reliable long-term index cash flows. And as I told you before, if you have long-term liabilities, you could match those long-term liabilities with these long-term assets. It's a very good match. Low correlation to traditional bonds and stock. Stable long-term yield. As I said, you have a long-term feature of revenues with predictable revenues. And you are relatively defensive. Why? What is defensiveness? Defensiveness is your ability to be resilient in terms of economic terms. If the economy goes down into recession, essential services to the population are highly unelastic. As such, they provide a defensiveness which is appreciated by the investors. And if you actively manage these infrastructure assets, you can increase the value of these assets, as you would increase the value of the real estate investment, for example, by renovating your asset base. You could renovate your asset base and increase its value. You could do the same with infrastructure, exactly the same. So that was my message to you today about, what are the key characteristic of infrastructure, what is the definition of infrastructure, and what could be brought to the table to investors. I think it's a good demonstration of what infrastructure can bring. And also, the second message was about, what is the landscape in which we navigate. And this landscape, as you can see, is very diversified by maturing degree of maturity between emerging countries, maturing countries, and mature countries. And I think this is a pretty sound and good way to start our trip to infrastructure. And I think that I hope you like this first session. I hope it brought to you several good and several long-lasting insight about infrastructure. That was my first live session with you. I think I will be extremely happy going forward with other sessions of that type. Don't forget and don't hesitate to post your question on the platform. These questions will be addressed. You can be sure of that. And please participate to the next live session where you will have another opportunity to ask questions. And also, I will also take this opportunity of being with you live to bring another theme around infrastructure. So each time I will develop a theme which obviously will help you to better understand what is infrastructure and what is its purpose. Thank you very much. I think we have now reached the time where we have to say goodbye. So I will part from you at that time. I would like to thank you for your participation. Hope it was a good time for you. And the next session will happen on 27th of April. And so it's in 15 days time. And I will be happy to have you again online. Again, thank you very much for your participation. See you next time, and have a good trip through the infrastructure MOOC. Thanks a lot.